Welcome back to Simple Mind Space, everyone. I'm your host, and I'm thrilled you're joining me for another insightful journey into the world of personal finance and valuable life lessons. Over the past few weeks, we've been exploring ways to prepare for economic uncertainty and build a rock-solid financial foundation. Today's episode dives into a crucial concept that often causes confusion: the difference between being a trader and an investor. It's a distinction many overlook, but understanding it can be a game changer for your financial well-being, especially when the market throws a curveball. So let's start by unraveling the world of traders. Think of them as the daredevils of finance, always chasing the next adrenaline rush. They're captivated by the fast-paced, short-term fluctuations of the market, constantly seeking opportunities to make a quick profit. The companies behind the stocks, not their primary concern. Their focus is laser-sharp on one thing: will the stock price go up or down in the coming days or weeks? Traders are masters of technical analysis, wielding charts, patterns, and indicators like weapons to decipher the mysterious language of price movements. It's like trying to predict the next move in a high-stakes poker game, a thrilling mix of skill, strategy, and a hefty dose of luck. There might be some telltale signs, some historical trends, but ultimately, predicting short-term market swings is like trying to forecast the weather. It's an inexact science, full of surprises and inherent risk. To paint a clearer picture, let's use a real-world analogy. Imagine a trader as a house flipper. They buy a property, give it a quick facelift, and then put it back on the market, aiming for a fast sale and a tidy profit. Long-term value? Not their concern. They're all about the short-term game, capitalizing on market demand and timing their exit perfectly. Now, let's shift gears and step into the world of investors. These are the patient strategists, the chess players of finance, carefully plotting their moves and focusing on long-term growth. They're not lured by the siren song of quick profits. They're captivated by the power of compound growth and building lasting wealth. They choose companies they believe in, companies with strong foundations, a clear vision, and the potential to thrive for years to come. Instead of relying solely on technical indicators, investors delve into the heart of a business. They meticulously analyze financial statements, scrutinize the leadership team, assess the company's competitive edge, and consider its future prospects. They're like architects, carefully selecting the best materials and meticulously designing a structure that will stand the test of time. They understand that real value is built brick by brick, with patience and a long-term vision. Think of an investor as someone who plants a tree. They patiently nurture it, provide it with the resources to flourish, and watch it grow strong and resilient over time, knowing that one day it will bear abundant fruit. Now, for many who are new to investing, starting with individual stocks can feel intimidating. That's where exchange-traded funds, or ETFs, come in. ETFs are like baskets of stocks, bonds, or other assets, all bundled together and traded on the stock market like individual stocks. They offer a great way to diversify your investments, reduce risk, and make getting started a whole lot easier. Think of it this way: instead of buying a single apple, you're buying a whole fruit basket. You get a variety of fruits, reducing the risk of putting all your eggs in one basket, so to speak. Choosing a good ETF involves a bit of research, but it's well worth the effort. Here are some key things to consider. 1. Investment objective. What are your goals? Are you looking for long-term growth, income generation, or exposure to a specific sector or market? There are ETFs for almost every investment goal imaginable. For instance, the SPDR S&P 500 ETF Trust tracks the S&P 500 index, providing broad exposure to the U.S. stock market. 2. Expense ratio. This is the annual fee you pay to the ETF provider, expressed as a percentage of your investment. Lower expense ratios are generally better, as they eat less into your returns. For example, the Vanguard Total Stock Market ETF, VTI, has an incredibly low expense ratio, making it a popular choice for cost-conscious investors. 3. Underlying holdings. Take a peek under the hood and see what the ETF actually invests in. This will give you a better understanding of its risk profile and potential for growth. If you're interested in technology, for instance, the Invesco QQQ Trust, QQQ, tracks the NASDAQ 100 index, focusing on leading tech companies. 4. Historical performance. Past performance doesn't guarantee future results, but it can give you an idea of how the ETF has performed in different market conditions. Look at long-term charts and see how the ETF weathered market downturns. This will give you a sense of its volatility. 5. Risk tolerance. Investing always involves some level of risk, and ETFs are no exception. Understand your own risk tolerance and choose ETFs that align with your comfort level. Now, while ETFs offer diversification and can reduce risk compared to individual stocks, there are still some potential downsides to consider. 1. Market risk. The overall stock market can fluctuate, and even diversified ETFs can lose value in a downturn. However, historically, the stock market tends to go up over the long term. 2. Sector or industry risk. Some ETFs focus on specific sectors or industries, like technology or healthcare. These can be more volatile than broadly diversified ETFs, as they're more susceptible to industry-specific headwinds. 3. Tracking error. An ETF might not perfectly track the index it's designed to follow, leading to a slight difference in performance. 4. Liquidity risk. While most ETFs are highly liquid, some niche ETFs might have lower trading volumes, making it more difficult to buy or sell them at a fair price. Investing in ETFs can be a fantastic way to begin your investment journey. They offer a simple, cost-effective way to build a diversified portfolio and participate in the growth of various markets and sectors. Just remember to do your research, understand the risks involved, and choose ETFs that align with your investment objectives and risk tolerance. In the coming weeks, we'll dive deeper into the world of ETFs, exploring different types, analyzing their strategies, and learning how to build a robust ETF portfolio. If you found this episode helpful, please hit that like button, share it with your friends, and subscribe to Simple Mind Space. Let's spread the knowledge and empower more people to take control of their financial futures. Have a great week, and I'll catch you on the next episode of Simple Mind Space.